presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello, everyone, and welcome to the Compak Asset Management YouTube update for December the 6th, 2022. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. Let's start with the market. The Fed is the big news. Last week, everybody said, after Mr. Powell's meeting, that the Fed is going to slow down the rate of increases. And the market had a great week, but I'm going to talk about what happened this week. Take a look at the economy, technical analysis, and market meter. Let's start with the Fed this week. Market expectation is that the Fed fund rate is going to be at 5%. That's the peak. That was last week that everybody was saying, well, the Fed came out, Mr. Powell said we can slow down the rate of increases. That means 0.5% increase in the Fed fund rate next on the 14th. But then we got the unemployment data. Stronger than expected. We got the ISM data, Institute for Supply Management. You heard Tony Nieves, he's the chairman of the Non-Manufacturing Business Survey Committee at the Institute of Supply Management. Numbers came out really good. So everyone that was looking for that recession said, wait a minute, what happened to the recession? It's not happening. So the Fed might have to raise rates more than the 5%. That's what scared everybody. And that's why the market started to come down. Even though the rates have come down, now the fear is the Fed is going to raise rates more, continue to raise rates into next year, slow down the economy, put it into a recession. That's bringing long-term rates down, but pushing short-term rates higher. That's the problem with the market this week. Next week, we get the inflation data, and that is telling us that that if we do get a lower number, that'll take this fear away that we're seeing this week in the market. But we have to get a lower number than expected. That means inflation is coming down and coming down fast, which is good because pre-COVID, we had low inflation. Low inflation by itself does not mean interest rates have to go up. But if inflation continues to be at the rates that it is now, then we need to slow down the economy more. The problem is we still have a lot of demand. People are still spending a lot of money because they have money saved up during COVID. Now that money is spent and they're spending on the credit card, sooner or later, we'll see that come back in balance. As I've said for the last year on the daily edition of Market Wrap, which you hear every day, and you can get the daily edition simply by going to the Apple Store, downloading, typing in Market Wrap with Moe Ansari, and you can get my daily edition of Market Wrap on your phone. And I've been saying that for a year. We need unemployment to go up. That's when the economy, when the fear of jobs comes to people, that's when people stop spending. We don't have that yet. The bond market projects inflation contained in the long term. That's what the market is saying, but we need to see that confirmed in the market. Year to date, laggard led November rally. We saw some of the stocks that had been beaten down the most took off to the upside the most. The value stocks are doing better. I think that's what we are going to see going forward into 2023. We are going to see a lot more of the stocks that have real assets, real companies, real earnings, rather than tech companies that were depending on future earnings. And those are being discounted more because of higher interest rates. The economy, labor market remains strong. We have to see some weakness in the labor market. We saw 263,000 jobs created. That was the problem that we're seeing. That's good news for the economy. Unfortunately, it's bad news for the stock market. So because when the economy is doing well, the Fed is trying to slow down the economy. The economy is not slowing. They have to apply the brakes more, means they have to raise interest rates more than what they've done so far. Non-farm payroll survey was around 200,000 was the expectation. We got 263,000 jobs created month over month. Slowdown, but still a very strong growth number. Don't forget to tune in. Again, if you want the daily edition of Market Wrap, just type the entire thing right here, Market Wrap with Moe Ansari, in the search button at the Apple Store. You'll get my free app, download it. You'll get the broadcast downloaded absolutely free to your phone every single day. Technicals, we saw interest rates hit this high of about 4.4, came all the way down. We're about 3.5 now, so we've come down 1%. That's how much, nearly a 1% decline so far in the 30-year. We're 3.513 today on the close. But this looks like a third wave, fourth wave. As long as we hold above 3%, that's this 200-day, that's the interest rate, we're okay. If we break below 3, then the economy, I think, will be in trouble. That's what it'll start showing, that we headed into a strong recession. You sort of muddle along here, come back up a little bit to 3.75. I think we'll be okay as far as rates. S&P last week got above the 200-day. This line right here, magenta line is the 200-day. 3 days we were above it, these 3 days. Then we start breaking down on Monday and Tuesday. We came down, broke below the 200-day, which is at 40.42. Broke below the 20-day, which is 39.64. Now we have to hold above the 38.25 because this is wave 1, this is wave 2, this is 3 on the upside, 4 on the downside, and then you can take off for the 5th wave. But if you break below here, which is 38.25, then this whole thing becomes an A, B, C correction. Rather than a 5-wave upside, it's an ABC. If we do get an ABC, that means this is a bear market rally. We're headed back lower. If we can hold above 3,800, which is about half of what we went up, we went from 35 to 41, that's 600 points, down 300, 50% pullback, brings us back to 3,800. I like to see 38.25, the 50-day moving average hold, which is still a pretty nice pullback. But I think as long as we hold above there, we get the inflation number down next week, and then we get the Fed raising rates by only 50 basis points and saying we're going to see how inflation goes, that will bring us back up. If we see a strong inflation number, the Fed coming out saying, look, we'll have to continue to raise rates, then this whole rally on the upside was just an ABC correction. Weekly charts, 4,200 is the number, then 4,100 is the 50-week moving average, and 39.41, which we are below as of today's. We are right there as of the close today, around 39.41. So we have to stay above there where we closed today to really be okay. NASDAQ already has become an ABC, as you can see, instead of 5 waves to the upside. We need to get above 12,000. That's really, and hold above 10,900. Today's close is 11,000. So we only have about 100 points to play with. If we don't, then this whole move on the upside is just an ABC. Same thing. This is the number, the dot plot that I'm looking at. We need to get above that, which is right around 12,000 for the NASDAQ. Oil prices hit the lowest price of the year today on a closing basis. Problem is China. If they do reopen, they get more COVID. That'll cause more shutdowns. The U.S. economy could be slowing if the Fed continues to raise rates more. Europe is already in trouble, and that could bring the demand for oil down. That has brought us down to where we are today. Even with the Russian cap on oil and all of that, oil prices are still under pressure. 74.47 was the close, and that is the lowest close we've seen this year. Gold prices got above, very similar to the stock market, got above the 1,800 on the 200-day, stayed there for a couple of days, but right now we're down. We have to hold 1,760 and then 1,700. Break below 1,700. This whole move was a bear market rally. As long as we hold above 1,700, this is just a pullback, and then we go back up. Those are my thoughts. Again, don't forget to go to compak.com, and you can sign up for the weekly newsletter that goes out, and you can, week ahead, we're going to get a lot of the data, inflation data, and what the Fed does with interest rates, and not what they do with rates next week. That's only going to be 0.5%. What they say they're going to do in the future. Where's the terminal rate going to be? Right now, the expectation is 5. If they start raising that, by terminal rate, I mean how high they're going to raise rates next year, where they're going to stop. That rate starts to move higher. Market has to readjust then to the downside. All depends on how the inflation number comes out next week, day before. On the 14th is when the Fed makes the announcement. 13 is when we get the inflation data. Those are my views. Those are my thoughts. Again, if you'd like help with your portfolio, give us a call or just go to compak.com, compak.com. I will be back with you at the same time next week. Until then, good trading.
This This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.